And March madness continues. The S&P 500 declined another 0.7% today, and the bulls simply cannot catch a break. Nowhere was safe. Safe havens fell, defensives fell, and buyers still on strike amid Trump's latest policies. But when we dive under the hood, there was some light at the end of the tunnel. Both the Nasdaq 100 and the S&P 500 saw net inflows today, despite the market price action. The after hours is looking largely positive, and there's been a massive uptick in global M2 money supply that's about to trickle down into the risk asset market. Bitcoin, a barometer for risk, is highly correlated to the money supply. And we all know that Bitcoin is just a 3x levered Nasdaq 100 index. By the way, if you want this indicator, go to TradingView, search FinFluential, and add it to your chart, offset by 72 days. It's all completely free to use if you have a TradingView account. So today, we're going to talk about when and where we will bottom. I'm going to give you support levels, exact dates, my directional bias, as well as price targets. We're also going to look at the latest charts. There are some great charts, and there are some very, very scary charts. So sit back, guys, relax. We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks bounced off their session lows late on Tuesday, but still closed in the red after a day of whiplash from President Trump on tariffs, which also saw ease from inline employment data. Guys, a pretty red day, broad-based, but we did see some green in some of the mega caps, and this was welcome. Look at stuff like Tesla. We saw a bit of a bounce back here, up 3.79%. We saw United Health was up 1.21%. Amazon gained a full percentage point as well. Meta was up 1.29%, and we actually saw quite a number of software names in the green. Look at Netflix, look at Salesforce, look at Intuit, ServiceNow, Palo Alto. This is really welcoming in the software space, and then Nvidia up 1.66%. Also AVGO up 3% as well, but the rest of hardware taking it a little bit on the chin. Financials as well, they were very, very red, and just across the board, it was just red in totality, except for some of these bigger names, which did see the Nasdaq 100 outperform, but the S&P 500 still falling another 0.73%. So after yesterday's brutal day, after last week's brutal week, we get another down day today. The winner out of everything was gold, up 1.17%, and that had to do with more trade policy. Tariffs continue to be front of mind. However, the technology sector XLK only down 0.38%. Very volatile. We were positive here in the middle of the day, positive towards the end of the day, and then we just had a bit of a pullback to take us into negative territory overall, with every other sector also falling. And look at industrials, communication services, and staples down 1.55, 1.44, and 1.43 respectively. Another brutal day for the equity markets. Growth outperformed, but that was about it. Large cap growth being the best performing sector, and that has been the theme of the last couple of weeks. Large cap growth has either been the best performing sector or the worst performing sector. There's been no in between. Very weird to see large cap value taking it on the chin, down 1.27% today. Mid cap core down 1.33% today. We also saw the core and value counterparts of large caps and mid caps also take it on the chin. However, mid cap growth just running flatline today, and small cap growth up 0.36%, but core and value falling as well. Very weird mixed trade, but the market pivoting back into growth. Maybe some of these growth guys, some of the bulls, looking at opportunities, especially longer term, looking 12, 24 months out, taking advantage of something like Nvidia, which is down nearly 30% from the highs, trading at a forward PE of very close to 23. I think people are looking at some of the stocks in this market and say, hey, some of this just doesn't make sense. I'm going to take advantage. And that is why we saw these growth names quite positive today. However, we'll see if this momentum can continue into tomorrow. However, a lot of this volatility and the fact that gold was up 1.71% was on the back of tariff and trade policy. President Trump on Tuesday said he's boosting Canadian steel and aluminium tariffs to 50%. These new duties will go into effect on Wednesday or tomorrow. And this is exactly what I said yesterday. I said Trump is going to retaliate strongly on the back of the 25% levy on electricity exports. Trump put out a post on Truth Social, absolutely hammering the Canadian government, as well as Ontario's Premier Doug Ford. And Canada did actually go ahead and roll back these tariffs on the back of their retaliation from the US. So you play stupid games, you get stupid prizes. But this tariff and trade policy war is ongoing and evolving every single day. We get news about this every day. I report it every day here on FinFluential television. So if you want more of the same, go ahead and subscribe. Now, what also did kind of support the overall equity markets was some of the employment data we got today. We got new labor market data released on Tuesday. This is the JOLT survey. Now, we got jobs openings. This was a big one. Came in at 7.74 million. The expectation was for 7.63 million. So there was slightly more jobs openings than the consensus. We also had some pretty positive up revisions right here. When it's in the green, we had positive revisions. When it's in the red, we had negative revisions, just so you know. Now, the JOLT quits also ticked up from the previous number. Now, you might see this as more people quitting their job. That is actually positive. It's actually a signal for growing worker confidence because they have the confidence to quit their job and go out and find a new job very quickly. So this is largely positive. We also had the Red Book Index coming at 5.7%. This is weekly year-over-year growth. So that's very positive for the consumer as a whole. And then the NFIB Business Optimism Index actually missed consensus expectations, but ever so slightly by 0.3%. So this is largely positive data, but the effects from that NFP report still being felt in the market. And the consumer as a whole, despite what the Red Book Index is saying, a lot of the stocks tied to the consumer not looking that good. Delta Airlines and United Airlines are down 20% each year to date. And in fact, you're probably down about 30 to 40% from the start of November. And this is because both these companies have cut their outlook on a weaker consumer as well as softening demand amid macro uncertainty. Both these airlines said they expect travel demand weakness, and these developments come as Trump doubles down on his trade war with Mexico and Canada. So airline stocks getting absolutely hammered. Another stock tied to the consumer down 24% was Kohl's, ticker symbol KSS. The department store chain joins a growing list of companies warning of a slowdown in household spending, and they produced very, very weak guidance. I wonder if management was just being conservative, but the market did not like it, down 24, nearly 25% today. Very, very ugly price action. Dick's Sporting Goods was also down 5.34%, and again, did see its strongest holiday season on record, but it's expecting profits to be lower than Wall Street anticipated in 2025. Owing to the slowdown, their guidance was pretty weak as well, and their guidance take into account sliding consumer confidence as well as the impact tariffs have on spending. And the executive chairman, Ed Stack, told CNBC, it's just a bit of an uncertain world out there. So these individual stocks, these names are telling us that we are starting to see a slowdown in the consumer. And by extension, that is going to hit the economy. And again, that is part of the reason why we're seeing all of the momentum fade that we are in the global stock markets. However, we did see a mild recovery of breadth, but breadth was still negative, with 3,200 decliners versus 2,900 advances. We did see inflows in the overall equity markets here in both the NASDAQ 100 as well as the New York Stock Exchange. The S&P 500 still down on the day. And then market momentum continues to remain sour, with neither the shorter term, medium term, or longer term averages above the 50% mark, meaning that for us to continue momentum to the upside, there is a lot of work to be done by the bulls, and that will only come with certainty. Now, looking at equities, we see a very red day, with the best performing index being the IWM pretty much flat on the day, down 0.01%. The Nasdaq 100, the S&P 500 fell. The RSP was one of the worst performing, down 1.33%. But we are seeing some positive momentum here in the after hours. I wonder if this is just a rebound from all of the ugly trade we've seen, or if there's a bit of news. Mid-caps fell. The S&P 600 fell as well. We actually saw growth outperform value, but value up in a very big way in extended hours. Guys, look at this right now. We continue to see what we call backwardation, where the spot VIX is actually higher than the front month VIX. Volatility did tick down, don't get me wrong, but when you see the spot VIX higher than the front month VIX, this often does tell us the volatility does have an expiration date and that we have higher near-term volatility than longer-term volatility. So around the March OPEX, we should see volatility continue to decline, especially if the VIX values continue to tick down from their highs we saw at the start of this week. This is a very positive sign for equity markets and often indicates a short-term bottom. Yields rose on the back of, I guess I would say, the strong economic data as well as some of the tariff news, and then the dollar actually did fall 0.5 percentage point, sitting at the 103 mark. Bonds fell as a result. Bitcoin was up 5%, and we're going to talk about Bitcoin and why I think it's due for a very strong rally. And then gold up 1%, silver up 2.73%, commodities were largely. But let's actually talk about some of the positives for risk on sentiment that we could be seeing over the next couple of days and or weeks. Now, this is Bitcoin, and for those of you that don't have it, you can actually go ahead and get my FinFluential Global M2 Money Supply Indicator. And if you offset it by 72 days, it provides a very accurate picture as to what Bitcoin might do in the future. The reason why we offset it is because it's often a leading indicator, and you can see Bitcoin follows the M2 money supply very, very closely. It tracks it with insane precision. We are nearing a bottom, as you can see right here. We did diverge a little bit from the indicator. However, we're putting in a bottom right here, and around the anywhere from the 20th to the 26th of March, which is also around the March OPEX, we should see Bitcoin follow the M2 money supply. Now, this is money supply that's already been entered into the system. The reason why we wait 72 days is because there's a trickle down effect from the money supply into Bitcoin, and we continue to see that from here Bitcoin can actually go ahead and take out all-time highs, the 108 area and above. So I am expecting a little bit more consolidation here in Bitcoin, and then pretty strong move to the upside. And I think equities should roughly follow that move as well. I think we are going to put a bottom in somewhere around the March OPEX period, anytime from pretty much now to the 21st of March. I think we're going to look for a bottom. Now, I do know that's a very long range. Today is only the 12th of March, or if you're in America, the 11th of March. And I think that bottom is going to be between the 5,400 and 5,500 area. So I am expecting a little bit more downside, but this is just a rough estimate. This could literally be the bottom. We definitely did see bulls come in a very big way. I am expecting a marked bottom sometime in this area between the 54 and 5,500 area, and again around about that March OPEX. However, we do have to take into account that if we go ahead and slip through this and continue selling post March OPEX, that is going to be very, very ugly, and then it opens up levels to as low as 5,100. But for everything I'm seeing right now, especially when it comes to global M2 liquidity, I think this is going to be the bottom right here around the March OPEX. Obviously, all subject change, don't get me wrong. We have to take these days as they come, day by day, and look at everything in granular fashion. But in the year and out, this is what I'm predicting. A low around about this area right here, anywhere between now and sort of the back end of March. We actually take a measured move from where we are peak to trough. We are officially in correction territory. We didn't close in correction territory, but we are flirting with that 10% mark in the S&P 500. Generally speaking, this is where you want to add your second tranche of shares, and then the next tranche would be about 15% lower. But our expectation is we actually don't get to that 15% pullback, and then we actually make a move from here. But like I said, all subject to change. The Nasdaq 100, very similar situation. I don't have an exact bottom for the Nasdaq 100 as I do the S&P 500. I'm a little bit more confident in my predictions and my models for the S&P 500. The Nasdaq 100, we are still in negative gamma. We did actually see the gamma flip lines move up a little bit. The core is the put support and the gamma flip did move up, meaning that the options market probably did see a little bit of bullish momentum today. And that's probably why we actually saw net inflows into the market despite the S&P 500 and the Nasdaq 100 both being down. So that is very interesting when you look at it. Nonetheless, it does look like we are seeing a little bit of dip buyers. We had a big wick here yesterday as well as today. However, there is still a little bit of downside. And for both the S&P 500 and the Nasdaq 100, we are in negative gamma. And that means we do target the bottom end of the range. That would be the 19,000 level for the Nasdaq 100. And that would be the 5485 level for the S&P 500. Looking at the RTY, very similar to the Nasdaq 100, we're in negative gamma. Our target is the 1975 area, and we're looking for some form of a low again, put in here around about the March OPEX period. But guys, the S&P 500, this is what we're expecting. So 54 to 5,500, round about here, somewhere in this March OPEX. We could reach this point tomorrow, and that could be the bottom. The bottom could be tomorrow. I'm just saying within this time period between now and the March OPEX, that's when the bottom could be put in at any time, and this is the range, but it could change if we go ahead and break below. So do be wary of that. But in the year, and I'm pretty confident we should actually go ahead, find the bottom right here, and then make our next move up. Will we go ahead and take out all-time highs? I'm not too sure, but obviously our first target will be the gamma flip and then the core resistance, and then we'll go from there. Dollar down another 0.5 percentage point. We're at this 103 area, actually closed below this key resistance level right here. So that probably opens up these lower levels closer to the 100 range. It has been quite a sell-off in the dollar. For those of you that track Trump 1.0 seasonality, this is largely not expected. And I did say that both the dollar and yields would fall the start of this year. Everything going according to plan. And in the very long term, lower yield and a lower dollar is going to support stocks, cost of capital, and the overall earnings picture, especially as they convert from a foreign currency to the US dollar as a whole. Let's look at TLT at the $90 mark. It does look like we're finding support right here. I do have a bull case scenario that sees us at the $95 area, but we are consolidating right here as yields take a little bit of a breather from this massive move to the downside. I do think we are going to go lower, which means I do think TLT is going to go higher. Will we reach the $100 mark? I don't know. I'm not too sure of that yet. What I can tell you though is we probably will see the $95 mark in the TLT in the very short term, anywhere from 3 to 6 months from now. If you guys want to know my exact stocks that I'm buying right now and a new stock I will be adding to my portfolio, go ahead and follow me, FinFluential Media. We're going to talk about the best stocks to buy during tariffs concerns, and then we're also going to talk about gold. I was going to do it yesterday, but I just didn't get time to talk about gold, but we're going to do a gold deep dive on FinFluential Media. So go ahead, follow me there. But guys, just to recap everything, we're looking for a bottom in the S&P 500 between 54 and 5,500, anywhere between today and the March OPEX. That's where we're looking for that bottom. If we go below, that can be ugly, but in the year and now, everything's looking like we form a bottom around about this area right here. On a peak to trough level, it would represent anywhere from a 10 to 12% drawdown, and that would be largely constructive and a great dip buying opportunity. So buy the dip, start deploying capital in the indices and stocks you like. I think this dip is starting to fade, and we should see some form of at least a tactical bounce going into the March OPEX.
And diving into sentiment, this is CNN's Fear and Greed Index. We are still in extreme fear. We've been here for quite a number of weeks now, since about late to mid February, and it's not without reason. The market and market participants, investors as a whole, are pretty fearful because Trump's agenda and his policy creates a lot of uncertainty. That is why we're here in extreme fear. However, when you look at the long run average of the S&P 500 returns, had you just bought the dip blindly when we entered into extreme fear, 12 months later, you're looking at an average return of about 15.2%. So you get outsized returns relative to the long run average. And so for those of you that are investors, for those of you that do have longer term time horizons, the pullback we are seeing in the market, this could be an opportunity, particularly if you are 20, 30 years old. Just buy this dip, let the market do its thing, and you'll come out better at the end. But let's actually get into granular fashion. Why is the market pulling back? It all has to do with earnings. At the end of the day, everything comes down to earnings and the market's expectations for those earnings. Now you can see here, this is Q1 2025. We are looking at a sequential decrease from Q1 here in 2025. We're actually looking at a 7.9% decrease in earnings quarter over quarter. Coming into the year and even as late as February, we were actually looking at a quarter over quarter increase, a sequential increase of about 0.2%. This would represent about 14% earnings growth in the first quarter 2025. The year-over-year growth is now 7%. So we've gone from about 14% year-over-year growth to 7.29% year-over-year growth. That is quite the decrease. So still growth year-over-year nonetheless. And this is the quarter upcoming. But this sequential decrease has really weighed on the US market because we were looking for a sequential increase and we only get back to baseline here in the second quarter 2025. However, the third and fourth quarters still look very robust with $70 and $73 in earnings per share. We're still looking to print about $270, very close to 12% earnings growth in the S&P 500 for the full year 2025. It's just that the markets had to reprice a lot. We've seen a lot of downward revisions, and that simply has to do again with the policy uncertainty of the Trump administration. Nonetheless, what it is looking like right now, especially in this administration, is that the earnings picture, like it was in 2024, is going to be loaded towards the back half of the year. If these earnings estimates start to come down in a very material way, and you'll only really see major revisions to them if we do get those revisions in like the second and third quarter for Q3 and Q4. But if we do see major revisions in these, expect this pullback to be long and drawn out. But as it is right now, it looks like Q1 is going to be impacted, Q2 a little bit as well. Q3 and Q4 look very, very good for us to continue. Even though we have seen a sequential decrease in earnings, we're still looking at a 7% year-over-year growth rate. However, that's not good enough for this market simply because valuations are some of the highest they've ever been. The US market as a whole sitting at 21.1 times. We're actually probably closer, I would say 21 or 20.9 times now. This chart is a little bit outdated. However, the All Country World Index looking at 17, and then Europe as a whole trading at a reasonable PE of 14.3, Japan at roughly the same. And then you have the rest of the world trading between the 11 and 13 range in PE ratios. United Kingdom trading just under 12 times. And so now you have to start asking the question, is it better to invest in these high quality US companies that trade at a massive premium with the massive policy uncertainty of the Trump administration, which is starting to look a lot like austerity? Or do you want to invest in European and Asian markets where the valuations are very reasonable, where central banks are cutting and governments are looking to stimulate with higher defense spending and just stimulus as a whole? And that is the balancing act the market is looking at right now. That is why we've seen Europe outperform to kick this year off and why we've seen the US markets underperform. And there is a case to be made. This is the Stoxx 600 year-over-year growth rates. This is where we are right now, the fourth quarter. Europe is looking to print 7.3% earnings growth. However, in Q1, we're looking at just above flatline growth, and then we're looking at 9.6% and 12.3% growth. And the bull case here for Europe is that with these rate cuts, with this stimulus, if you can start to see maybe the fourth quarter growth reinvigorated, Europe stocks are significantly cheaper than what the PE suggests. And even if we see maybe some upside here in Q1, Europe could actually be trading at like maybe a 13.5 instead of 14 times forward. That is a really good discount for a central bank that's cutting and a government that's stimulating versus US markets that might actually grow roughly the same in the year, but trade at nearly double the premium. You see, the case for Europe really starts to make sense when you look at it in that light. I don't have the answers for you right now. All I can tell you is that US stocks really have a great history of growth and outperformance, and a lot of the companies in the US have significantly wide moats and they can weather almost any storm. Europe doesn't quite have the same quality of companies as the US market does, but again, that's baked into the valuation, and you do have the central banks and to a degree some of the governments that are on your side, particularly in stuff like Sweden, Germany, the UK, these NATO countries. They're really looking at stimulating, cutting rates And again, that's very, very supportive for the economy as a whole. Going back to the S&P 500, this is some very interesting data. This is how often the S&P 500 has peaked for the year in each month since 1980. You can see that generally speaking, when we have peaks or when the S&P 500 makes its high for the year in January, February, or March, particularly in January, the returns in that year tend to be very lackluster. In fact, not just poor, the returns tend to be destructive. When a high is made in January, the average return is 18.6%. Luckily, we actually didn't make a high in January. We did make a high in February, and we're yet to make a high in March. So it does look like we can eke out a very small gain, again, based on this data set, because of the all-time high we've made in February. However, here in March, we didn't put in a high. And generally speaking, the later on in the year we go ahead and put that high, the better the overall return outcome is. Nonetheless, this is a data point that is looking a bit grim for US stocks, and to a degree does support the thesis that maybe it's time to look at European stocks as a whole. However, everything is going to come back to the macro and the economy, and we are starting to see a tangible deterioration in the US markets. Goldman Sachs lowered their Q1 GDP estimate from 1.7 to 1.3%. So it's not quite the negative print of the Fed's GDP now, but we are starting to see lower growth. We are starting to see inflation expectations ease. True inflation is officially below the Fed's 2% target. This right here can quickly turn into a deflationary spiral. So guys, I'm willing to bet that rate cuts are going to come a lot quicker than you think. And I think a part of the reason is that the consumer is going to get squeezed, especially with tariffs. All Americans, except for the richest 20%, will pay more in tariffs than they will get back from the Trump tax cuts. And in fact, tariffs are expected to cost the average household $1,200 per year. Now, that is significant. Looking at earnings tomorrow, Wednesday, we have the two big ones here after the close. Adobe, UiPath, Sentinel-1 as well. American Outfitters is reporting, and that's pretty much it. I don't see anything of note before the open, so it's really just these big three software and cybersecurity names that's really going to move the market. I think a huge amount of attention is going to be paid to Adobe as a whole because it's been a bit of a dumpster fire over the last 12, 18 months. Looking at data tomorrow on Wednesday, we get the CPI data. We get the core numbers as well as the headline numbers. So month over month, year over year core, the forecast is for 0.3 and 3.1%. And then the month over month, year over year headline figures is for 0.3 and 2.9%. That's pretty much it. And so this is going to be the big data point. I'm expecting a somewhat of a inline or cooler print than expected. We may start to see some of Trump's policies in their inflation data. We're in wait and see. And then on Thursday, guys, we get the PPI as well as initial jobless claims. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.